Hey everyone, it's Simon here and welcome to your Accelerate Members video for Thursday, the 6th of January 2022. Now, according to Bloomberg, Wednesday was the biggest selling of high growth, high valuation stocks in a decade. And you know we've been watching these high growth, high valuation stocks. We're short a handful of them because they've just been getting absolutely whacked, and that selling only intensified yesterday. Today was the fourth worst reaction to a Fed minutes by the S&P 500 since at least 2007. Now, a lot of those big down days did happen during 2008, but it is worth pointing out that poor performance on Fed minute days typically lead to more selling or at the best, unremarkable performance on average. So if history is any guide, this weakness has probably got a little bit further to run. I'm not saying that this is the top of the market and where a bear market is starting, but I think we could probably expect another 2 or 3 days worth of selling, at least on the SPY, and Nasdaq could be slightly worse. Just looking at the S&P 500 here, you can see that we had a pretty solid close lower, almost 2%, closed right on its dead lows for the day. What's potentially more troubling is that we've closed below the previous all-time high. So we had a little bit of consolidation above this area. We've now closed below that area, which means stop losses on anybody who bought this breakout are going to start getting hit. Okay, so we could certainly see further selling into Thursday and possibly Friday as well. Once those stop losses have been hit, it remains to be seen. Maybe the market can kind of find a bit of a bottom Monday next week, and we get a turnaround Tuesday. That's the kind of thing that I'm expecting at the moment. Been highlighting this Fibonacci 1.272 extension area as a likely area for at least a short-term high for a little while, and you can see we came up, butted our head against it a couple of times. Just managed to peek its head above it on Tuesday, and then we got a big downdraft yesterday. So what happened to spook the markets in such a way? Well, it was the release of the FOMC minutes. And within the release of those minutes, it seems that the FOMC are going to focus more on raising rates than reducing the size of the balance sheet. There was a phrase in there: participants generally emphasized changes in the target range for the federal funds rate should be the committee's primary means of adjusting the stance of monetary policy. The minutes also said the appropriate pace of balance sheet runoff would likely be faster than it was during the previous normalization episode. So they're committed to the taper, and they're committed to liftoff by the sound of the minutes. And the market is locked in now 3 interest rate rises for this year and 40% chance of a 4th interest rate rise. So not something that's really going to please the equity market, particularly with a recommitment to the taper. The minutes also revealed that almost all of the members stated that they had revised up their forecasts of inflation for 2022 notably, and many did so for 2023 as well. So certainly consistent with the hawkish pivot that we saw from Chairman Powell in November, and not music to the equity market's ears, that's for sure. Now, just to put a little context around this move in the S&P 500, I mean, all it's done so far is pull back to the mean. All right, so really and truly, it's a normal pullback. It's just that it happened all in one day, so it feels a little bit abnormal. But you can see the S&P will often pull back to 2 ATRs below the mean, even 3, before finding support. I mean, in a stronger trend, it will find support, the mean or 1 ATR below. But 2 ATRs below, I think, is a reasonable downside target, which will bring us back to kind of 4,600 and change. So that would imply approximately 100 points more of downside. We can kind of corroborate this using some Fibonacci ratios as well. So what I'm just going to do is draw on the Fib levels from here to the all-time high. And if we pull back to the 61.8% retracement level, that's 4618, call it 4620. So probably, 4600 is a nice round number. 4620, we've got some Fib support. I would think we're a good chance to get down to that sort of level maybe in the next 3 or 4 trading days. And if we see signs of stabilization, probably provides a good buying opportunity. Now, if we have a look at the Nasdaq, the picture is slightly different. Okay, the Nasdaq's actually in pretty bad shape here. Not only was it down much more heavily, the Nasdaq was down 3.3%. It's clearly punched through the 50-day moving average and on its way to the 100 and the previous high here. This is kind of, I guess, the last bastion of hope is it retested this high and these recent lows. But when you get a big bearish candle like this one, you usually don't turn around on a sixpence. There's usually at least a couple more days selling, like we saw here, and that's what I'm expecting with the Nasdaq as well. Although I'm less bullish on a rapid turnaround in the Nasdaq. I think I'll be focusing more on SPX related stocks than tech in particular. I've been talking to you a lot about the breadth problems that we've been seeing in the Nasdaq. Okay, this is the advanced decline line, and what we've seen is the advanced decline line peaked all the way back in February 2021. Even as the Nasdaq continued to make new high after new high. But with the declining breadth, the declining advanced decline line, that's indicative that fewer and fewer stocks are participating in the strength in the Nasdaq, which is, it's not healthy. It's not what we want to see. And then during this kind of chop fest, we saw breadth just get destroyed. And whilst we did see a nice thrust in breadth here, I mean, this problem, it's not fixed. And the point I was making was that we're pretty much reliant on Apple and Microsoft and Google and Tesla to keep rallying to sustain the index. We're in a situation where if kind of a handful of stocks give up the ghost, it's going to spell big problems for the index. Because for the index to find its footing, we kind of need to see the other 95 stocks all start to rally, and that's obviously a lot harder to achieve. So if we look at the kind of the big stocks in the Nasdaq, obviously Apple is the biggest, $3 trillion company, and the trend here still looks really, really good. But it was down 2.66%, and it's always going to be tough for the Nasdaq to rally when Apple's having a rough day. When Apple and Microsoft are having a rough day, Microsoft down nearly 4% there, you can forget about it. When Apple and Microsoft and Google are having a rough day, it's going to be a rough day all around for the index. And you can see here Google lost 4.6%. We've got a daily squeeze here, which is fired short, and potentially a fair bit of energy to be released to the downside there in Google. Tesla is the other one that's kind of been holding things afloat. And I mean, Tesla still looks okay here, but it was down almost 5.5% yesterday. So when you've got really just those four stocks all having a tough day, it's going to be really tough on the index. Looking quickly at the Dow, let's look at the Diamonds ETF. It was only down 1%, and it actually made a new all-time high before reversing lower. Now, in the process of closing down, it did complete a bear reversal candle, daily bear reversal, which usually will carry some downward momentum with it. But at least here the trend is more intact. We've still got Rainbow Logic. And the Dow tends to be obviously a lot more pro-cyclical than the Nasdaq, which is really focused on tech and to a lesser extent healthcare. IWM continues to be in trouble here. IWM, this is the Russell 2000 ETF, was down 3.4%, and have a look where it failed. It failed right at the Fibonacci 50% level and the 50-day moving average. All right, so it kind of makes complete sense that this is where the rally would stop. It's not to say I was expecting a 3.4% flush out the very next day, but yeah, it's certainly a logical place on my analysis for this rally to have paused. IWM, the clear underperformer of the kind of the major indexes that we track. Looking at bonds, so looking at the 30-year bonds, which is kind of what I've been tracking, we've had a pretty strong move lower since it broke the 200-day moving average. As you know, I was short TLT. I decided to take the money and run yesterday, locking in a 78% gain on my TLT puts. I think TLT is probably due for a bit of a bounce here. And if we do see a rally back up into the 21 EMA, I would certainly look at that as an opportunity to get short again. But I think not a lot of downside left in this move. Okay, so if we do start to see bonds kind of regain their composure in the short term, that could help the Nasdaq find its footing as well. If we look at TNX, which is the 10-year note index, you can see 10-year yields up around 1.7. So they've surged higher and kind of taken out this recent top as well. Now that's not to say they can't pull back, and in fact I think they probably will. I wouldn't be surprised to see 10-year yields pull back to this 1.55, 1.6 area, but I do think we're likely to see a 2 in front of the yield sometime in the next couple of months, say first quarter. We may end up with a situation where the bond market kind of does the Fed's tightening for them. The stock market won't like that move in all likelihood. If we do get a move up to 2% on the 10-year note yield, it's going to be tough for the equity market to really rally in the face of that. But if the bond market ends up doing quite a lot of the Fed's heavy lifting in terms of tightening, we could start to see a more dovish Fed, and the equity market would love that. But this is all pure conjecture. Let's stick to trading the charts in front of us. Just looking at some of the major sectors now, and even though we had a big sell-off, S&P down almost 2%, Nasdaq down almost 3.5%, it didn't look like just a complete puking in risk. It looks more like sector rotation, sector repositioning. If we look at the market map, I mean, yeah, there's a lot of red on that screen, but it's not universally red, okay, which is what you see when the market is just kind of puking up risk. We actually had some strength amongst the energy, utilities, basic materials, consumer defensive, consumer staple stocks, and even healthcare saw some pockets of strength as well. The other thing we didn't see was a surge higher in the dollar. If we look at DXY, I've been calling this a topping pattern for a while. We didn't see the dollar surge higher, which you would normally see in a big risk-off move. Obviously, we didn't see a surge higher in bonds; they were weaker. We didn't see a surge higher in gold either. So your traditional safe havens, dollar, gold, really didn't move at all. So those are, I guess, other reasons why I'm not expecting the move that we saw yesterday to be a harbinger of a new bear market. I think we're just looking at a January correction. And I shouldn't use the word correction because the correction implies a 10% pullback from all-time highs. We may not even get that. Let's have a quick look at oil now. So oil was down fractionally. Oil futures are currently down about 1.26%. I reckon oil is done here. I think we've seen the rally that we're going to see in oil, and this could prove to be a fairly important top. I'm expecting we could see a multi-week top here. Now let me just change to a cleaner chart so you can kind of see what I'm talking about here. We've got these little trend channels. We're kind of right at the upper end of this trend channel that's been in place for a few weeks. But more than that, we've got some fairly relevant Fibonacci levels that I think are worth pointing out. The first one is that this 100% line here means that this rally from that low to this level here is exactly the same size as that rally from there to there. So we've got some Fibonacci symmetry there. Just bear with me, it's going to take a little while to explain all of this. If you look at this 0.618% level, which is right on the same sort of level there, that means that this rally from that low to this level is 61.8%, which is a Fibonacci ratio of that rally from that low to that high. And then if we take that low to that high and project from this low, we get to this 100% level here. So it means that this rally is the same size as this rally. And then if we just take a Fibonacci extension from that recent swing high to the recent swing low, we're at the 1.272 extension. All right, so there are a bunch of kind of interesting Fibonacci relationships here as well, which lead me to think that oil is almost certainly done. It's not to say it's going to make new lows, but I'd be really surprised if this high gets taken out anytime in the next few weeks. And I'll talk you through a potential trade in oil later in the video. Just going back and looking at some of the major sectors now. Let's have a look at ARKK, which is kind of my barometer for high beta, high growth stocks that probably don't have any earnings. And that was down 7%. And it had already had a pretty severe beating. All right, so this is just telling us that high growth, high valuation stocks are still getting smacked down. Let's have a look at IPO, the ETF that tracks IPOs. Looks very, very similar, doesn't it? That was down 5.2%. Let's have a look at biotech. We can look at XBI, which is the Spider Biotech Index. That was down 5.5%. We can look at IBB, the Nasdaq Biotech ETF. That was down almost 4%. All right, so high beta sectors really, really getting hammered. We could look at SKYY, which is a good barometer for cloud computing stocks. It's down 3.8% and making new cycle lows. CLOU, which is another ETF tracking cloud stocks, similar sort of thing, down 4.3%. If we look at IGV, which is the software ETF, that was down 5%. All right, so you can see a lot of drama here. And if you look at these charts, you look at IGV, I mean, this is an important component of the Nasdaq. If you look at SKYY, it's also an important component of the Nasdaq. These ETFs have been under serious pressure since November, but we haven't seen it in the Nasdaq, all right? And that's because it's really been masked by the performance of Apple and Microsoft and Google and Tesla. Now, in contrast to the massive sell-off we've seen in tech, if you look at something like, well, let's look at XLE, even though I'm not particularly bullish on oil here, it was steady. If we look at XLP, it was, it wasn't up, it was only down 9 basis points. If we look at XLV, healthcare sector, again, it wasn't up, but it was only down 71 basis points. So we're not just seeing wholesale selling across the board. We are still seeing, I think, reallocation. It's just that tech is a big sector. And the other sectors are probably just not quite big enough to absorb a heap of selling out of tech, all right, because it is such a dominant sector in the S&P 500. Anyway, onto my positions, and I mean, in hindsight, Tuesday wasn't the best day to unwind my bearish butterfly on the SPYs, but fortunately, the short positions in things like Okta and Garmin and also NEO have been very, very handy. My NLV was only down, I think, 1.3% last night, which even though it was down, I was actually pretty ecstatic with that as an outcome, just given how weak the broader market was.